Good morning and happy Friday. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And here are three things that you need to know this morning. One big event on the docket today. Federal Reserve Chair Jay Powell speaking at Jackson Hole. He's expected to strike a measured tone after last week's minutes hinted at upside risks to inflation. Investors expecting him to touch on data dependency and that all-important neutral rate. Last year, Powell spoke for just 8 minutes. This year, we're expecting perhaps a slightly longer outing at the podium. Jackson Hole serves as the last big catalyst for investors as the summer closes out. Yesterday, the Boston Fed's Susan Collins told us we may be at a place where the Fed can hold steady. Today, Yahoo Finance speaks with the Philadelphia Fed's Patrick Harker. He's been of the opinion that a restrictive stance is the best policy right now. We'll also get the take of former Fed presidents Esther George and James Bullard. And results season drawing to a close. We learned a fair bit. There were a lot of beats, but it didn't necessarily translate to good news for the shares. Consumer dynamics are shifting. We saw that in the retail numbers. Dick's Sporting Goods, Macy's, Foot Locker, they all saw shares take a big hit on a weaker outlook. The big driver of sentiment was meant to be Nvidia. It didn't disappoint investors, but they still kept one eye on Jay Powell, and the stock didn't do that well when all was said and done. Well, Fed Chair Jay Powell set to speak live from Jackson Hole, Wyoming in about an hour. Yahoo Finance's Jennifer Schonberger is joining us live from a chilly morning Jackson Hole with what we can perhaps hear from Powell. You know, I guess you get those beautiful backdrops, but it comes at a price in terms of your extremities, Jen.
Good morning, Julie. Yeah, it's a chilly 45 degrees here in Jackson Hole, so I had to haul out the coat here for late August. But as you guys just previewed, all eyes on Fed Chair Powell in about an hour's time here in Jackson Hole, where he's expected to deliver a major policy speech. Last we heard from the chairman, he wasn't convinced on inflation yet to hold rates steady. Speaking after the FOMC meeting on July 26th, Fed Chair Powell said that rates hadn't been held in restrictive territory long enough to really feel those full effects. He says the Fed is committed to holding rates in restrictive territory until the central bank is convinced that inflation is convincingly coming down to their 2% target, even if that means raising rates again. Now, last year, Fed Chair Powell caused the markets to swoon when he said that higher rates could lead to pain and higher unemployment. This year, Fed Chair Powell walks in with the belief that there is a pathway to bring inflation down without causing a spike in the unemployment rate. Powell has the fortune of dealing with a strong economy now, a consumer that is spending at a healthy clip, and a job market that, while cooling, still remains strong. Now, we have gotten a couple more cooler inflation reports since the Fed met in July. The question du jour is whether that is enough to convince officials that inflation is on a sustainable pathway downwards to their 2% goal to hold rates steady here. We will hear from Fed Chair Powell at 10:05 Eastern live here in Jackson Hole.
All right.
Back to you.
Tons to keep an eye on out there. Yahoo Finance's own Jennifer Schonberger. We're going to be checking in with you throughout the day. Thanks so much, Jennifer, for that scene setter there. Beautiful scenery. Stock futures are rising ahead of Fed Chair Jay Powell's speech in Jackson Hole, Wyoming. Every word he uses will be studied for clues on the interest rate outlook and whether his tone means more hawkish or dovish. He will likely move markets. And joining us now, Evan Brown, UBS Asset Management Head of Portfolio and Multi-Asset Strategy. Is there a magical word that the markets want to hear from Fed Chair Jay Powell today, Evan?
I think probably the magical is progress, right? That's what we've seen on inflation is it's finally coming down, and Fed's not going to declare victory. Powell's not going to declare victory, but we are seeing that progress, and that should be enough to get the Fed not tightening much more, right? And sticking with this language of we're going to keep rates higher for longer. And I think that's enough in a still solid environment. Then markets should be okay.
Hey, Evan, it's Julie here. You know, whether he talks for 8 minutes or 12 minutes or 6 minutes, I mean, and whether he tries to really give a very straight, neutral presentation today, you know the markets are going to parse through everything and maybe react or overreact to certain elements of it. How do you as a strategist kind of cut through all of that to what is most important in what he's saying?
Yeah, I mean, the most important thing is really comparing what he's saying today to what he said at the FOMC meeting in July. And what has changed? That's always the most important thing. And we don't think that enough has changed in the data for him to shift from that script. We are seeing inflation come down. We are seeing the labor market gently cool. And so there's not much we think that's going to get Powell to change his view. So, markets are waiting for this risk event. I think it'll pass, and then we'll move on to what's a lot of important data next week.
Even if not enough data to change, still, there could be a lot of kind of how the Fed is thinking and what the course of their kind of dialogue and the discussions have held thus far that he might feel the need to elaborate on even further in what they've seen in terms of how the economy has digested the policy moves that they've made thus far. And so perhaps that gets us to the length of this speech, because last year, 8 minutes, if he comes out and, sends the tone to the markets that, I need to speak longer than 8 minutes, it needs to maybe go 15 or 20 minutes, do the markets kind of latch onto that at all and say, okay, this is a more clear-headed but also a more thorough type of speech that the Fed felt like it needed to give, given how the economy is digesting all of the moves that it's made?
Yeah, so I think we haven't seen much of a change in the data, but what we have seen is a change in the bond market. We've seen yields rise quite a bit from when Powell last spoke, and rise at further out the curve. And what the market is doing there is they're saying, hey, the Fed has raised rates so much up to now, but the economy is still hanging in. If anything, there might be some signs of acceleration. The Atlanta Fed GDP now is at 5.9% estimate of GDP for the third quarter. And so the length of the speech, I think, will have to do with, does Powell want to start talking not just about the near-term outlook, but does he want to start talking about what the long-term neutral rate is? Does the Fed, given low interest rates that have been locked in, 30 years fixed across the economy, that's made the economy less vulnerable to interest rate hikes, does that mean that the Fed has to land at a much higher rate than they've been projecting, which is about 2.5%, is like the long-term average rate that they will aim to come down to? So the length of that speech, does he really start to dive into that? He can start talking about it, given that it's such an important discussion in the markets. But will he break new ground? Will he say, we do think that rate is fair? I think it's a little bit early for them to make that judgment. He's going to say, hey, we'll feel it out based on the data and reevaluate as we get more data and think about how that prior tightening in financial conditions, is that still, with a long and variable, it's still going to feed through to the economy?
Right. And I was going to ask you to dive a little bit deeper into that long-term neutral rate, also known as R-star, to folks in the wonks in the profession who watch it. Do you think that eventually, you're saying it's too early for him to call for that to be a higher rate. Do you think eventually he's going to have to go there?
I think eventually, yes. I mean, we do have things this cycle that are different. I mentioned the structure of housing market and interest rate payments that are very low for a good part of the population that owns a house. We do have more stimulative fiscal policy than we saw last cycle. Green spending, infrastructure, and the like. We have a slowing of globalization, which is going to put upward pressure on inflation. So there are reasons to think that inflation will be structurally higher than last cycle. And I think the Fed's ending point as a result, the R-star, or long-term neutral rate, will be higher. But the thing is, the market has already priced a lot of this. So the Fed may be at 2.5%. But measures of the long-run neutral rate are actually at about 3.6% right now. So over 100 basis points above what the Fed is saying. So, we'll watch Powell, and yes, if Powell starts to acknowledge that, you could see another move higher in yields. But we do have to keep in mind that the market has gone ahead of the Fed at this point.
I just want Powell to tell me when I can buy a house. That's it, Evan. Stay with us for a hot second here. Stocks on pace to open higher as the investment world will be listening to how Fed Chair Jerome Powell frames the fight against inflation, which could be a potential trigger for a correction. And earlier this week, we saw investors' obsession with Nvidia and the AI revolution move markets. What news could move risk assets next? Evan Brown is still here with us. And so is there any news that the Fed could signal here, at least in the realm of what it can control, that the markets would pay close attention to, and beyond the fervor that we've seen around the AI trade, where other pockets within the market have some propensity to move here today?
Yeah, so I think what we're seeing in the market, the response to Nvidia, the wobbles that we're seeing in risk assets, are perfectly normal when we're in a seasonal period of August and September, where stocks tend to not do that well. And let's keep in mind that the NASDAQ is up 30% year to date. So it makes sense that we take a breather. Market will look at Powell. A lot of people are out of the office, so there's not going to be a ton of liquidity there, and markets can move quickly. But as people come back and survey the data of next week, of which we have quite a bit, with core PCE inflation coming in, with the payrolls report coming in, people will come back after Labor Day. They'll size up the data. They'll size up earnings, which really have been quite good. And I think as we get past this seasonal period, that data will show that the Fed can kind of level out, because we've seen that progress on inflation, and the economy is in reasonably good shape.
So, Evan, what does one do from a strategic perspective? If inflation moderates, if the economy is okay, do you go all in on cyclicals, for example, given that kind of view?
We would take a balanced approach to equities. So we all know that valuations are high in the U.S. equity market, and that is really being driven by mega cap tech. So it is expensive. It's also hard to bet against, because we're all just, let's be honest, guessing on how powerful this AI trend will be, and so it's really hard to bet against those mega cap tech stocks. But where we see valuations as much more attractive is in mid caps and small caps, and more the equal weight index. It doesn't mean you're necessarily short tech, but you're choosing to have an overweight in equities in those indexes where valuations, PE ratios, are below the last 10-year average, where there is a little bit cyclicality. We like sectors like industrials, for example. We expect global manufacturing to pick up later this year, since the consumer is in reasonable good shape and inflation will be coming down. So somewhat of a cyclical bias, but more than anything, just a balanced bias to the market.
We've seen the NASDAQ composite under pressure this past month here. If there's anything that we'd seen perhaps pulled forward, it's a lot of the demand, the hype phase around artificial intelligence certainly had done well for tech as a whole. But if there is kind of a period of time where the investors, where the market expects these companies to start delivering on that, and then also to see it trickle through into their margins, what type of normalization might we see even in the valuations within tech?
Yeah, I think the market is taking time to digest and really think about who are going to be the winners and losers, how much is being front loaded. And so there was all the AI hype earlier this year, but now investors are being a little bit more discerning, and that means more differentiation within the market. It means that maybe it's a little less of the big mega caps that were the big winners that everyone poured into, but now we're thinking about who can be the winners in terms of other industries where they're using AI to an AI investment to improve productivity, to improve margins. And so that is kind of consistent with our idea of the equity market rally broadening out. And also there being more differentiation and more opportunity for active investors who can really look at the earnings reports, who can look at the plans on investing in AI and the potential improvements in margins, who can look at how companies are managing costs in this environment. And so it's a good environment for active. It's a good period for digestion in the main indexes driven by mega cap tech, and a more discerning environment for the active investor.
And Evan, finally, on the fixed income side, we've been talking to a lot of folks lately who like the shorter end of the curve in this environment, potentially. Where are you guys looking on the fixed income side of the spectrum?
Yeah, so we've been in the short end of the curve. It's hard to argue with yields at well above 5%. In what is still a pretty uncertain environment. But we're increasingly, as yields increase further out the curve, we're increasingly adding some duration. And the reason is that, as I mentioned, we're positioned in equities in the more cyclical areas of the market. The vulnerability in our portfolios, we always want to be diverse. The vulnerability in our portfolios is if growth surprises to the downside, is if payroll employment next week surprises to the downside, and the economy suddenly becomes a lot weaker than we're expecting. So we want to have that duration exposure as 10-year yields have picked up to 4.25%, and have some diversification in case the economic environment deteriorates and the outlook for the Fed is that they'll be cutting rates sooner. You want that duration exposure. You want to be balanced in your portfolio.
Evan, thanks so much. Appreciate it. We'll see what Chair Powell has to say in less than 45 minutes. Evan Brown, UBS Asset Management, Head of Multi-Asset Strategy and Portfolio. Say hi to Luke Kawa for us, will ya? Thanks so much, Evan. Well, shares of Gap, we're watching them this morning. They're a little changed, only up about 0.75% after reporting earnings after the bell on Thursday. Gap beating on earnings per share, but reported a sales decline across all brands in the second quarter, down 8% from the year prior to about $3.5 billion. In a call with analysts, CFO Katrina O'Connell warned of a choppy consumer market, saying the company would be prudent in planning for the months ahead. The company anticipates a drop in revenue for the upcoming quarter, with net sales decreasing in the low double-digit percentage range. The company's new CEO, former Mattel executive Richard Dixon, he stepped into his new role just on Tuesday. He was on the call. He didn't have a lot of specifics to offer on the call, but that makes sense considering he's only been in the job for about 3 days. But I think a lot of these numbers just show the challenge that is ahead of him. He talked about reigniting and reinvigorating Gap's brands, but how he's going to do that, I think, remains the question.
Yeah, and if there's anything that we can perhaps extrapolate from his time at Mattel and perhaps annex that or kind of use the transitive property, bring that over to Gap, you could see more collaborations. Of course, Gap had tried that. They tried that with Kanye West or Ye. That didn't necessarily work. You tried that with a few other kind of instances. And for Gap as a whole, of course, you've got the different subsidiaries, and Old Navy really has been the company that had put the team on its back for so long, to the point where at one point they were looking to spin off Old Navy into its own business. And so now you look across some of these other brands. Banana Republic had a pretty good year to this point, at least, as it seemed people were perhaps gearing up to get back into some of those in-person capacities, whether that be at work or at school. Athleta has also been interesting in tracking how they're competing with some of the other athleisure plays. I believe we were just talking about it in our newsroom, and some of the fanfare was certainly permeating within there a few days ago. But at the same time, you look across some of the results that came out in this quarter. Total company net sales, there was a foreign exchange headwind, but including those factors, total company net sales would have been down by about 5%. Comp sales were down 6% in the quarter, but they did say in spite of the sales declines, they're reporting that all 4 of their brands gained or maintained market share during the second quarter, with particular strength in the women's category. So we'll see.
Yeah, I thought that was interesting. And Katrina O'Connell, again, the CFO, was also asked how things went how things have gone over the past couple of months. Did she see any kind of improvement? And she did say there was some improvement. On the conference call, she talked about that, especially in Gap and Old Navy. She said back to school is going okay also. So that's something that's perhaps a little bit more encouraging. And she also said she is watchful of the trend of student loan repayment, which she said would primarily affect customers of Old Navy. I think, the question here is, Old Navy in particular, since it does target a lower income consumer, are those people just not buying? Because they're not trading. What do you trade down to from an Old Navy, right? So I guess that is the question here. They're maybe not buying as much apparel in this environment. Something else that stood out to me from the call as Richard Dixon settles into his role, and by the way, he's not the only new person at the company. Remember, Athleta has a new head, a former executive from Alo Yoga. Alo, thank you.
Alo?
I always get that wrong.
I've been getting
Chris
it wrong.
Blakesley is the new guy coming in there. But Dixon sort of emphasizing the size and scope of Gap. I mean, it's still a huge company. They have 90,000 employees at the company, and they sell through 900 million units a year. So 900 million pieces of clothing or whatever it is that they're, apparel and pieces that they're selling.
It'll be interesting to see what he does on the storefront side, too. The company ended the quarter with 3,456 store locations. You think about the
They've been shrinking it.
Yeah, they have. And you think about the annexation that this company has had to the mall and the prominence of the mall for the past, 15, 20 years, if not more, and how many of us growing up had been able to walk into a Gap or a Banana Republic or, one of their owned entities or an Old Navy within a mall experience. But now that foot traffic is changing elsewhere and there is more of a mix shift to go directly online for a lot of consumers, at least to initiate their search or to get inspiration. If some of those stores, you see that continue to shrink, where they might reposition other stores and perhaps even shrink some of the square footage that they operate too, which is something that we've heard over the course of this earnings season, even as we were listening to some of the results from a company in Macy's as well, how they're looking at for many of these mall annexed or mall known type of pillars for many years, where they're going to look to some of those smaller locations to really make sure that they're still having that consumer touch point. Get in, feel the clothes, put them on, try it on, whatever, see if you like it, walk out with it, great. If not, then you can have another type of realm where you spend more into that digital and that direct to consumer as well.
Right.
Also here, we've got all your markets action straight ahead. Stay tuned, you're watching Yahoo Finance.
Was Nvidia the spark that growth stocks needed to reignite?
We'll know that for sure over the coming weeks, but it certainly doesn't hurt. I mean, Nvidia has been the catalyst pretty much for most of this year in terms of sparking. ChatGPT sparked the AI fever, but Nvidia really became the way to play it, and so. It does seem to sort of give an all clear or safe to get back in the water despite all the headwinds that might be hitting growth stocks. But it is a bit of it's an outlier. It's too tough to extrapolate.
Former President Donald Trump turned himself into a Georgia jail after being charged with his fourth criminal indictment since March. He then took to X, formerly known as Twitter, for the first time since being banned to tweet out his mugshots. And then that has set off sort of an interesting, cascade, if you will, in shares of DWAC,
Yes.
right? Digital World Acquisition Corp.
Yeah, the company that, of course, through the SPAC process was looking to take on Truth Social. And so with that deal, ultimately, this is the kind of proxy for any type of movement, anything Trump related. And you're seeing shares move down by about 5.3%, perhaps because he didn't take to Truth Social directly. He went to X, or formerly Twitter, in order to initiate that activity. That's where his base has been for so long, whether over the course of his presidency, even leading up to then him being booted from the platform, albeit temporarily at this point. In the grand scheme of things, I think making sure that he can leverage these opportunities, at least from his team's perspective, to continue to play the victim card in how they're kind of framing their own calculus ahead of the 2024 election. We'll see if that works out for them. But for Digital World Acquisition Corp, it had some meme tendencies at first, and now just kind of moves.
Well, it still sort of has some meme tendencies. Yeah. I mean, the company has to complete its deal. Yeah. DWAC is supposed to take over Trump Media and Technology Group. It has a deadline of September 8th, or it has to give $300 million back to investors. So there's a lot at stake here. At the same time, he did post on Truth Social and said it's his home. So, but that stock is quite a volatile one in terms of DWAC. So just keep that in mind as we watch the moves. Let's also take a look at moves of Nordstrom. Those shares have been up a little bit, but really little changed after the company beat estimates for the second quarter, but stuck to its cautious outlook for the coming months. Sales are still struggling to rise to pre-pandemic levels. This was an interesting trajectory, where we saw the stock go up initially after the report, then it came down in post-market trading. Now it's sort of bumping along here. There are two things that seem to be affecting the future-looking revenue. One is a comment on credit card delinquencies that echoed what we heard from Macy's as well. Credit card revenues did rise 10% in the first half. CFO Kathy Smith, though, said that delinquencies are gradually rising and are now above pre-pandemic levels. And the other issue is the one that we've heard so much about from the industry this quarter and last quarter, and that is shrink, that is theft. CEO Eric Nordstrom telling analysts losses from theft at their highest ever.
Yeah, I mean, this company was at the center of one of the more viral videos that we've witnessed shrink actually taking place. Shrink, theft, of course, the whatever euphemism you want to put on it, it impacts these companies, and we've heard it time and time again over the course of this earnings season. Something that's also impacted companies is the amount of sales or promotions that had to be moved forward. They had a massive anniversary sale timing during the quarter that shifted from the second quarter to the third quarter. Negative impact there of about 200 basis points on net sales compared with 2022, they mentioned. And then additionally here, you look at the gross merchandise value that was sold. That decreased 8.5% during the quarter as well. So the shift in what consumers are buying right now, whether they're actually buying it or not, or just walking out the store with it. And then additionally, just the categories that Nordstrom is continuing to buy into. And I think where those discretionary decisions are being made by customers in the store. Yeah,
I want to just say a quick word about Rack as well, Nordstrom Rack, which in this environment, in theory, should be performing well for them. You see the likes of a TJX that's been doing pretty well here. And it looks like that was a bright spot for the company, but not bright enough a spot to maybe offset some of these other points of concerns for investors. So just something to continue to keep an eye on here in this, pressured environment for consumers. Let's take a look at what stocks are doing here. We just had the opening bell on Wall Street. Let's do a quick check of the markets. All three major averages up about 0.5%. Everything could change in about 30 minutes when we hear from Jay Powell in Jackson Hole. But for now, ending the week on a bit of an up note here as investors try to anticipate what he is going to be saying. It's been a weird week, let's be honest, right? We've had all this anticipation for Jackson Hole. We had a lot of anticipation for Nvidia that ended up with the stock kind of going a little bit all over the place before the day was done after it reported, Brad. So it's been, now we end here, but it's been a little bit of a strange week.
You're right. Everything could change. It has been a strange week, but for right now, everything is awesome. Everything is cool when you're part of a team. Dow Jones Industrial Average right now higher by about 0.5% as we start off the day. About the same case on a percentage basis for the NASDAQ Composite. It's up by about 0.5%, 0.4% for the NASDAQ Composite. And the S&P 500, same case there, percentage basis up 0.4%. We mentioned the S&P 500 and you just saw the chart, so let's also give you a look at the 11 S&P 500 sectors here to start off the day. Green across the screen. We won't dilly-dally here for too long, but let's take a look at XLY, consumer discretionary. You're seeing that move higher, leading the pack. It's up 0.8% as we start the day. The NASDAQ Composite, taking a look at the tech-heavy average. It's been an interesting week. Can we take a look at the 5-day period for this? Okay, so it's been some deep gainers, deep decliners. But for the deepest of the gainers here, mRNA, that's been interesting to track as well. Anjali Kamlani has, of course, been breaking down some of the moves in that healthcare sector for us over the course of the week. It doesn't want to light up that chart, so we're not going to do it. But let's put this back on the intraday just to give you a look at how some of those mega cap tech stocks are doing. I'll put this back on a market. And then additionally here, Apple, Microsoft, Google, that's where you're seeing some of the moves transpire here. Apple and Amazon both up by about 0.9%. And then additionally, Microsoft up 0.6%. Alphabet, though, lagging. That's down by about 0.5%. Nvidia giving back a little bit of the gains that we saw over the course of this week after they had reported earnings, which showed that there was still a little bit of room to run for the AI trade here. But for Nvidia, it's down to start off the day by about 1.2%. And we'll continue to track that as we move closely towards the weekend. Yeah.
We are really focused on sporting goods retailers right now. It has been a bad week for them, except for this one. Hibbett Sports, bright spot in the retail space today after reiterating its full-year guidance, despite other retailers, particularly sporting goods ones, feeling pressure from rising levels of shoplifting and also maybe lower consumer demand. The company's same-store sales did fall 7.6% year over year, but profit did come in ahead of expectations and perhaps a bit of a relief rally here because Hibbett has been under pressure along with the rest of the sector over the course of the week. The company also holding fast to its full-year profit forecast, so that also could be helping matters here.
Yeah, this was an interesting report here because two of the things that jumped out to me on headline when you kind of first looked through the release was that they had second quarter comp sales decreased by about 7.3% and net sales were down 4.6% year over year. When we were looking at this and knowing that they were going to be reporting earnings this morning, we said it could be a similar reaction that we see in what Dick's had seen earlier this week. And Dick's, in that decline that had taken place, they still have not recovered from that after they had reported earnings here. But you got to wonder if investors are just kind of looking out into the future here, looking at some of the opportunity for Hibbett in what they had put into their guidance. But those comp sales decreases, and then additionally, e-commerce sales decreases 5.2% year over year on a year over year basis, and that representing 15.1% of their total net sales for the period. You just got to wonder, like, what investors are paying attention to on this one.
Well, maybe they're paying attention to bad news being priced in, perhaps. Sure. We saw the weekly chart there. We also saw the chart year to date in which the stock is down almost 40% going into today's numbers. So the bounce then makes it's still a chart that does not reflect a lot of optimism over the longer term for the company. And if you look at these numbers, to your point, they're not great numbers. Year over year declines in comps, in earnings per share, gross margin advancing year over year, but falling year over year, but beating estimates at 32.8%. Just to give a little background as well for those who aren't as familiar with Hibbett Sports, I feel like Dick's is a more national name, right? Foot Locker certainly a more national and international name as well. This company headquartered in Birmingham, Alabama.
Oh, I was just down there.
Where I know you were. And they have just over 1,100 Hibbett and City Gear stores in 36 states. So more stores actually than Dick's. But I think Dick's has a bigger store. The stores themselves are larger.
Sure.
But just to give a little bit of color on what this company is for those who don't know.
All right. Well, next time I'm down there, I got to pop in one.
Yes,
Pick
you
up
do.
something from Hibbett
Check it out.
Sports.
Do some channel checks.
Yeah, awesome. You know I do that at Foot Locker all the time anyway.
know you do.
And Disney, we got to talk about them here on the day. I don't do enough channel checks at Disney. Disney closed at its lowest level in almost 9 years yesterday as the company looks to implement a turnaround plan, including price hikes and cost cutting. Yahoo Finance's Alexandra Canal joins us now with the breakdown. Hey, Alec.
Hi, guys. Yeah, not a good time to be a Disney shareholder. And I want to repeat that. The lowest level in nearly 9 years. October 17th, 2014, the stock closed at that point $82.68. That's actually a little better than what we saw shares close at on Thursday night, down 4%, trading at $82.47. If we look at shares right now, they are actually up about 1%, but still below that critical $84 mark. And if we compare that to the S&P 500 as well, Disney has underperformed the broader market, declining nearly 5% year to date compared to the S&P's roughly 15% gain. And this comes amid a lot of challenges for this company. We have a parks business that is declining. We have subscriber losses. We have linear TV challenges. And there's a lot of uncertainty here as Bob Iger really tries to reset the tone and the future of this business. He's suggested that perhaps linear networks aren't core to the business and they are exploring strategic options that could include a sale. We also have ESPN taking that fully over the top in the background, the information reporting that Amazon and Disney are currently in talks. And when you hear that and you think about the future of this company, analysts have wondered, is Disney too big at this point? Do you split it up? And who's in that conversation? The FANG names. We have the Apples, the Amazons of the world that could potentially come in there and gobble up some of those parts of the business. So a lot going on top of the leadership problems. We don't have a permanent CFO. We don't know who will replace Iger at the end of the day. So I just think this murky future is having investors take a step back a bit.
I mean, so there's a lot of hypotheticals in here, a lot of hypotheticals. If it could maybe do this and that.
Yes.
What concrete steps do investors expect the company to take to maybe help the stock in the short to medium term?
I think it's been pretty much set that ESPN is going to be fully over the top as a direct-to-consumer streaming service. We don't know the pricing of that. The information said that Disney is exploring between $20 to $35 a month. Now, that would be one of the highest streaming services on the market at a time when consumers are leaving and abandoning their plans due to higher prices across the board. And when you take a look at the landscape right now, all of the streaming giants really want to boost engagement. What boosts engagement? Sports and live news. That's what analysts have told me. That's why I saw Warner Brothers Discovery launch CNN Max, that 24-hour news section. We'll see if
you mean CNN Plus?
It's basically the rebrand of CNN Plus.
I mean,
yes.
come on.
But that's a bid for engagement. It might not lead to a subscriber boost, but it's going to keep people on the platform longer. And sports has long been viewed as that as well. So I think that is one of the things that investors are really hinging their bets on moving forward. But in terms of everything else, you're right. It could go a zillion different directions. So it's one of those companies we're just going to have to continue to track.
All right, era of spinning teacups for Disney over there. Thank you so much, Ali, for breaking this one down, for us this morning. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Here's a random one. What do you make of VinFast?
SPACs are back.
Are they though?
No, they're not. But selectively they are. I mean, VinFast has everything you'd want in a meme-like stock. I'm not going to call it a meme stock, but it's electric cars. It's a very thin float. It's non-U.S. based, and some of we've seen much more crazy trading in some of the new listings that have come out of Asia rather than the ones that are domestically focused. And so you've got all the ingredients. Is this company worth more than Ford and GM at this point? It seems ridiculous, but that's not. If you're trading VinFast or if you're investing in VinFast, you're not thinking in those terms. You're saying, oh wait, this stock can double in a day or triple in a day, and if it goes down 50%, maybe it'll come back next time. So. Which it has, exactly. So you've had everything in its short lifespan.
Yeah.
Investors are watching for key signs of what's to come from Fed Chair Jerome Powell's speech today. And Yahoo Finance's Jared Blickery, oh yeah, he's standing by too, and he's joining us from the floor of the New York Stock Exchange for more on what to keep an eye on. Jared, good to see you.
Good to see you, except I'll have to wait a few minutes to get into the office. Jackson Hole, this is a tradition that goes back to the 1970s. Paul Volcker was one of the first to go over there. It was off my radar until the global financial crisis. After QE1, it seemed to be an appropriate time in August of that year to address some things like when is QE2 coming and a bunch of other items. So it's been kind of an ad hoc response to whatever has been going on elsewhere in the year, or erstwhile in the year, and this year I think is going to be no different. Yes, last year was kind of an exception to the talk that has normally gone on, and I wouldn't be surprised to see a few surprises this year, but the market reaction, this has been a gangbuster year in stocks. I'm not expecting that much in stocks. Let's go to the Wi-Fi Interactive. I'm going to chart what's been happening this week, and I think it is instructive to see what is happening with the Dow versus the NASDAQ. Dow is down not even 1% for the week, but the NASDAQ up almost 2% there. And when you take a look at the sector action, it's really been, once again, all about the mega caps, reminding me of earlier in the year. This is what's happening today, everything in the green. Here's what's happening over the 5 days. Tech, XLK, that's number one. XLY, that's consumer discretionary. Then real estate, but also communication services. That's another mega cap sector. That's still in the mix as well. Been really interesting to see all this against a backdrop of rising interest rates, of stronger interest rate. We've seen some fluctuation this week, to be sure, but even on the up days, we haven't seen that taking the wind out of the sails of the tech trade. So it's really been something to behold. Having said that, all of that, I want to point this out on the Wi-Fi Interactive. I'm going to show you a 2-month chart of the NASDAQ NASDAQ Composite, along with the 50-day moving average. You can see yesterday we launched right down from that 50-day, and I did a study going back about 40 years in the NASDAQ when we get that really downside thrust off of the 50-day moving averages, and I'll show you a couple more examples that happened over the last year and a half. Here's a yellow dot, here's a yellow dot. Some of these do get continuation, and in fact, the history of the pattern was more negative than I would have thought. 45% over the next day, 45 to 50% down over the next 5 days, 10 days, and 21 days. It's only when you get out 1 quarter ahead, 63 days, that you really start to see a favorable bias once again. So whenever I see something in the indices which have a natural bias to the upside, of a lot of negativity, I take that in stride. So I do think that we could see some continuation here to the downside off of this movement here, and it's going to be really interesting to see, because now we know that the 50-day is in play. And I'm telling you what, I'm going to end on a cheering note here. We have a Little League crew, just won a championship. They're walking through, and it's nice to hear some noise on a Friday afternoon like this.
Love it.
Or morning,
love it.
excuse me.
Even if the NASDAQ will be going down, at least a little sun. Oh, yeah, we got Little Leaguers running around on the floor of the New York Stock Exchange. I love it. Thanks, Jared. Appreciate it.
You bet.
Well, millions of people are expected to travel for Labor Day weekend next week, and a new report shows you may be getting a cheaper deal. Though hotel prices in the U.S. have risen slightly from last year, airfare and rental car costs are both down over 10% from 2022. That's according to a new report from Hopper. And Haley Berg, Hopper lead economist, is joining us now to talk through it. So we obviously have seen some moderating prices across the economy. I got to say, I was a little surprised by the moderating prices in airfares in particular, because A, we know there's still a lot of demand, and B, anecdotally, it doesn't feel like those prices have come down. So where is that pressure sort of letting up?
We hear that so often. We're quoting these low prices, but consumers don't feel like they're seeing them. And part of that is some behavioral changes. People are planning trips much more last minute than they did pre-pandemic, meaning they're missing out on some of the best and lowest prices. But domestic prices are really down, driven by the higher supply the airlines are operating at the end of the summer this year, a much earlier peak in summer demand. We saw the majority of folks taking trips in June, July, and early August. So we've entered that low demand period about a week or two earlier than we have in previous years. All of that is going to drive airfare down for Labor Day weekend in particular. Comes at the end of the summer. It's not always the highest demand long weekend of the summer. And that's really why we're seeing about $225 for airfare, down about $75 from what we saw earlier this summer and 4th of July weekend.
It's really interesting. And as we think about travelers getting ready to perhaps make those flights, catch them, some of them might miss them. It's unfortunate. At the same time, the airlines, are they better equipped now at the end of the summer to really deal with the influx, the volume of demand that they're going to see?
I would say airlines every day since really the end of 2021 have been increasingly better equipped, better trained to handle the volume of passengers that we're seeing. There was a huge influx of new hiring in 2022. Those people had to be trained. And it's not just the airlines, it's the airports as well. It's the FAA, air traffic control, TSA. So we had a relatively successful summer. We did not see the incredibly high disruption rates we did in 2022. But it is a fact that disruption rates are higher now than they have been, pre-pandemic. About 25% of flights delayed on departure, between 1% and 2% canceled. That still impacts thousands of passengers a day.
Does it dissuade them from traveling, though, Haley? I mean, and I take that also with the report that recently came out, I believe, from the New York Times, talking about how many near misses there are because of our air traffic control system. Do we see any kind of hit to traveler sentiment as a result of all of this?
We haven't seen it on the Hopper app. Most of our users are Gen Z, millennial, so they definitely are more focused on travel than some of the older generations have historically been. The most interesting thing we're seeing, though, is that about 1 in 5 of our users are paying extra, a little more than $30 additional, to buy a disruption protection product when they check out with their flight. That's something that allows them to rebook for free on the next available flight if they're canceled, delayed, or miss a connection. And that right there shows us that though travelers are price conscious, they continue to check the price of trips many times before they book, they are prepared to pay a little extra for peace of mind in case they are canceled or have a major disruption in their trip.
Are people upgrading, and beyond just buying protection, are they upgrading their experience even after that initial purchase?
We always see travelers upgrading, whether it is selecting seats, moving to a higher cabin class. That's something that's been persistent even since pre-pandemic. If anything, we've seen the airlines start to make some strategic changes to capture more of this premium demand, expanding their premium seat selection spaces, in some cases even removing first class to expand business or premium. Mm-hmm. So there is definitely a lot of demand for premium out there. But when we poll our users, getting the best price and getting an affordable trip remains their number one priority, even ahead of anything like more legroom.
Haley, let's talk more about what happens after Labor Day to pricing here. When we look across those 3 categories, airfare, hotels, rental cars, do we see a downward trend?
Absolutely. It's a seasonal downward trend, though. We always see fares, hotel prices, even rental car prices, which are relatively stable throughout the year, drop for any travel taking place in September, October, and the first 2 weeks of November. We call this the shoulder season. It's post bucket list summer vacations and pre-holiday travel. Most folks are headed back to school, back to work. It's a low demand period. We always see prices come down. They do seem to be coming down a little bit more sharply this year than in previous years. We're seeing about a 30% price drop from summer peak to where we are today, headed into September. But we do expect that'll be short term, as it is every year, and prices will start to rise about early October as travelers start booking those Thanksgiving, Christmas, and New Year's trips.
Okay, so that's exactly what I was going to ask. What can we extrapolate from Labor Day travel to give us any type of insight into how the holiday season will fare?
Holidays are going to be busy. We're expecting it. We've got more capacity this year than we did in previous years. And even in previous years, 2021 and 2022, we saw very high demand for the holidays. We're expecting it to be busy. We are hoping that travelers will have a little bit more flexibility given remote work, more relaxed schedules. So we won't see the crushing demand for some of those departure dates. Take, for example, Christmas. We're seeing it's at the end of a weekend. Thursday, Friday, Saturday are going to be huge demand days for travelers, very expensive. So hoping some additional flexibility will allow travelers to take advantage of those cheaper flight dates. But it will be a very busy holiday season with hopefully fewer technical breakdowns that cause disruptions. But as you know, we can't control the weather.
Yeah, we're looking at you, ticker symbol LUV. Haley Berg, Hopper lead economist, thank you so much for joining us here today. Appreciate it.
Great to be with you.
Likewise. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
A lot more still to come here at Jackson Hole, where the Federal Reserve's big annual meeting is underway.
Fed Chair Jay Powell speaks at Jackson Hole imminently. He's expected to strike a measured tone. Last year, Powell spoke for just 8 minutes. This year, we're expecting a slightly longer outing at the podium.
Today, Yahoo Finance speaks with the Philadelphia Fed's Patrick Harker. He's been one of those of the opinion that a restrictive stance is the best policy right now. We'll also get the take of former Fed presidents Esther George and James Bullard. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
In Jackson Hole, how long is Jay Powell going to talk this time? Last year, he made headlines because his speech was quite short.
I think he's going to keep it on the short side. I think he's going to I actually expect a fairly similar tone because one of the things that I've noticed about him is he likes to be nice when he doesn't get too confrontational in the press conferences. In Jackson Hole, he's standing in the middle of the prairie talking into a camera by himself. So he's just going to say what he has to say and move on, I think.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving right now. First and foremost, stocks are higher as we await Fed Chair Jerome Powell's speech from Jackson Hole, Wyoming. In just a few minutes here, investors will be combing through his words to find any hints for future Fed policy.
And let's take a look at some individual names. Hawaiian Electric slipping today on news that Maui County has filed a lawsuit against the utility company over the deadly wildfires that devastated the area earlier this month. There are now at least 3 lawsuits alleging that the wildfires started with strong winds knocking down Hawaiian Electric power lines. Meanwhile, the company says it's suspending its dividend. It's already drawn on $370 million from lending facilities as it faces these legal problems. S&P Global Ratings has also followed Moody's and Fitch in downgrading Hawaiian Electric. They now rate the company AB- from BB-.
And we are also watching shares of Workday, the company topping analyst estimates for revenue and earnings in its second quarter. The company also provided a positive outlook, expecting 18% year-over-year growth in subscription revenue, citing strong demand and potential growth in artificial intelligence. The positive report has prompted analyst price target upgrades. Mizuho raised their target to $260 from $250, saying the company has several levers to drive growth. And Needham boosted their rating to $250 from $220, seeing the potential for AI to drive growth.
And we are also watching Marvell Technology. The chipmaker reported a drop in revenue in its third quarter as macroeconomic uncertainty caused enterprise clients to pull back. Marvell has also had a hard time in China as U.S. rules restricted the exports of certain chips to the country. Analysts are still betting on the semiconductor company's potential in the AI space. All right, we're going to toss it back over to our Jennifer Schonberger in Jackson Hole.
Hey there, Julie. Fed Chair Jay Powell standing resolute here in Jackson Hole, saying that the Federal Reserve is prepared to raise rates further if needed. Chair Powell referencing his speech from last year right off the top, saying that while his speech is a bit longer this year, the message remains the same: to bring inflation back down to the central bank's 2% target. Powell saying, quote, "We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective." Powell said that while inflation has moved back down, inflation remains still too high and that there is still a ways to go. This despite a couple of encouraging inflation reports after the last FOMC meeting. Now, he also said that the rebalancing here's Fed Chair Powell right now. Let's listen into him live.
Inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue, or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the 3 broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened, and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend, and recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. and we will keep at it until the job is done. Thank you.
That was Federal Reserve Chair Jay Powell out there in Jackson Hole. And listening to that speech, which was a little bit longer than last year, obviously, but the whole stay the course message still sort of remains the consistent through thread from last year's speech to this year. And Powell reiterating that despite what some economists and investors we've spoken to have been saying, that, oh, maybe the Fed should raise its inflation target, he said, we're not doing it. The inflation target remains at 2%.
Yeah, and it was interesting to see exactly, and again, in the duration of this one, 100% year-over-year increase in the time spent speaking for Fed Chair Jay Powell. So that, no doubt, a significant, by some standards, measure there. But the decline in inflation so far, he really started off really pointing out how the policy had taken effect to this point, saying that by the time the Federal Open Market Committee had raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. Fast forward. Now think about where we are here in 2023. You're still looking at a labor market that the Fed has been able to lean on to this point in time. And, even as they're looking towards their 2% goal, and that remains their 2% goal, he was adamant about making sure that that was mentioned a few times within this speech. It's just a matter of where the economy might start to show pockets of weakness to get to that 2% goal as well.
Yeah, I'm taking a look at what's happening in the markets right now, and it actually seems stocks are taking this pretty well. If you look at the major averages, not only are they in the green, they're a little bit higher than where they were before he began speaking. Now, that could change as we see investors sort of digest his remarks, but we're also not seeing a heck of a lot of movement in Treasury futures at this moment. A little bit of sort of bouncing around, but it does seem that even though one could potentially read the tone of this as somewhat hawkish, it doesn't seem to be hawkish enough yet, as read by the markets,
right,
to derail the rally that we have been seeing.
Or at least more so than we expected from that hawkish tenor. Let's bring back in Jennifer Schonberger, who is in Jackson Hole, Wyoming for Yahoo Finance. Jennifer, all right, take us into what you heard from Fed Chair Jay Powell, and let's make some sense of what the markets are reading into here as well.
Brad, yeah, the market reaction is a bit surprising to me because the Fed chair very much striking a strongly hawkish tone. He wants to send the message to the markets that the Fed remains resolute in bringing inflation back down to its 2% target. He doesn't want to loosen financial conditions at all. The Fed has really taken pains to try to raise rates and tighten financial conditions, cool the economy to bring inflation back down. There's still a ways to go to do that, he said. I thought it's interesting to underscore that he referenced his speech from last year, saying that while his speech this year is longer, his message remains the same, which is to bring inflation back down to the 2% target. He even used the same language he used in last year's speech, saying that we will keep at it until the job is done. Of course, he underscored that there is the potential for further rate hikes from here, but that the committee is going to proceed cautiously at this point. They've done a lot of work, and they can take a step back and watch the data and move more cautiously in coming meetings. I also think it's important to point out, Julie, as you referenced, that the Fed chair made a point to say that they are keeping their inflation target at 2%. He said it is and will remain 2%, sort of a response to those who have called for perhaps a higher inflation target here to avoid further rate hikes. So certainly a resolute, hawkish message from Fed Chair Powell here in Jackson Hole. Guys.
Right. Yahoo Finance's Jennifer Schonberger there for us, who's going to have a few more big interviews throughout the day. Thanks so much, Jennifer. Well, we just heard from Fed Chair Jerome Powell in Jackson Hole, Wyoming. Powell delivering a somewhat hawkish tone on inflation and interest rates in his speech. Let's bring in Rich Lesser, Boston Consulting Group Global Chair, to weigh in. Rich, just want to get your headline takeaway, your perspective from what you heard from Powell.
So I would have described it as more cautious than hawkish. And I think we have to respect that you can't look at the numbers and believe the job is done right now. We're even if you say there's a little flex around 2, it's not at the level that we're at today. It needs to come down further. No one can know if we're finished or not in terms of what needs to happen. But I was actually quite pleased that at the balance of saying we might be able to pause now, or we might need to go further, and we're going to let the data guide us on doing that. I'm not surprised the markets are reacting positively to that versus taking a strong stand, either that we're done and if anything, we can start lowering, or on the flip side that we need to go even higher. I thought it was a pretty balanced message.
And what did you say? Hey, Rich, it's Julie here. It's good to see you. What did you make of this sort of, I thought it was interesting. He sort of took input by input, right, of inflation and kind of what they're seeing and what they want to see and how much time it takes to make its way through the economy, which seems to sort of also nod towards some of the critics who have said, let all of this percolate through the economy a bit more because of the long and variable lags. What did you make of that?
Personally, the way he disaggregated the different components and tried to talk about what each one meant and how to read it, I thought was really welcome. And I think there's such a tendency to try to drop to a single number and use that to tell us where we're at versus looking at the different components. I also really appreciated him calling out that real wages are what we really care about in terms of helping workers in this economy, and the real wages are now running ahead of inflation, that it's improving, and it's not necessarily where we want it to be, but I think that was a positive message. And in an ideal world, we want wages to outpace inflation for the long term. And that means that we can't be looking at that we're looking to get back to 2% wage growth as some marker of success. If 2% inflation is the headline number we're looking for. So I thought him breaking those different components apart made sense, and I'm not surprised that that's the general reaction based on the market so far.
Rich, it's been interesting over the course of the earnings season to hear how banks who have views into consumer balances, how they're thinking about consumers, how retail companies who are engaging with them on a transactional basis are thinking about the consumers and evaluating the consumer, and now how Fed Chair Jay Powell is evaluating the consumer as well, saying recent readings on consumer spending have been especially robust, and in addition, after decelerating sharply over the past 18 months, housing sector starting to show signs of picking back up. All of this evidence the Fed weighs to really kind of paint a picture of how they view the consumer. But does that give you a sense that the consumer they're seeing still needs kind of more checks or more curbs put in place so that spending doesn't continue to kind of buy into this inflationary environment?
So at least what I hear from our clients is not a sense of a robust, out of control consumer spending landscape. I think we're seeing mixed signs, depending on which retailers you look at, about how they're seeing their businesses evolve. I think consumers who still have relatively healthy balance sheets, particularly after a bout of inflation, you could have pictured a much worse situation. Consumer balance sheets are still relatively healthy, but we're not in the position we were in 2 years ago. And on the flip side, the supply side's come back as Jay Powell talked about. So if anything, most of our clients are looking at this landscape and realizing that on the one hand, they don't want inflation more than anyone else, but that actually a low inflation power with consumer balance sheets not quite as strong puts more pressure on pricing power, which has declined as it should in a lower inflation environment, and puts more pressure on finding growth through other means. And I think that we're hearing that from our clients. I think we'll see a huge focus in this year's planning cycle as our clients and as companies in general look to 2024 to figure out not just how they continue to become more resilient and more productive, but how they unlock growth levers in a somewhat more challenging environment. So I think the companies that we're talking to, and we see many of them, are seeing a somewhat more challenging environment on the consumer side than was presented today.
Rich, I definitely want to dig more into what you're hearing from your clients, because I think that's really interesting. But first, just one more question on the substance of the speech. Do you think the Fed should be sticking to 2% here? Do you think that that is realistic? And at some point, is it going to have to relent and say, well, maybe 3% is more realistic?
You know, there was a wonderful speech given by Lael Brainard, who is now in the White House, but this was when she was in the Fed pre-COVID. So, by the way, can you see me okay?
Yeah.
Okay.
We gotcha.
And we hear you even better.
Okay, great. She gave a speech that talked about average inflationary targeting and noted that 2% is the long-term goal. No one's debating the 2%, but that we will go through periods where we average a bit under 2, as we did most of the last decade, and we will go through periods where we average a bit over 2%. It doesn't change that 2% is the target, but it does say that an obsession to get to 2.00 fast is not necessarily serving the broader economy. And I think at a time when we see this de-risking of supply chains going on, things that will add some net cost as companies focus on other factors to build supply chain resilience, when we see a time when there'll be massive capital spending going into the economy with all the bills that have passed and the focus, I personally think that principle that, yes, we're targeting 2% in the long term, but we may be in a period where we're willing to live with something a bit over 2. Starts with a 2, but not necessarily 2.0. I think that could be a very reasonable place to land. Obviously, that will be a call of the Fed, not of the rest of us. And we'll see. But I personally think, just as we did in the last decade, not obsess to go to negative interest rates in order to drive inflation back from something that started with a 1 to 2.0, we may be in a similar position. But if I were Jay Powell right now, and for sure I am not, to be crystal clear, I think I would still be signaling in the long term 2.0 is the number.
And then, Rich, we did want to circle back and talk about what you're hearing from your clients right now. Are those that deal directly with consumers, B2C style, or even B2B, are they struggling to try and figure out whether or not they can continue to raise prices? And if so, are they considering starting to drop or bring down prices?
I don't expect to see much in the way of price. I mean, there's always promotions and ways you deal with short-term pressures to lower prices to drive demand in the near term. I've not heard talk of lowering prices, but I've certainly heard, I think there's a lot more pressure about how much more price increases you can push through in a lower inflation environment. And by the way, we want that. I mean, for many years, you know, retailers have often been a champion for the consumer to push suppliers to not push through big price increases, to try to keep price increases as low as possible. And I think that we're returning much more to that world. But that puts the pressure on everyone, producers and retailers and the whole supply chains, to then find other sources of growth when you can't get that through growth just through pricing power. And frankly, that's healthy. That's where our economy should be in general. That's what a stable price environment means. But I do think that pressure is returning in a big way. And I think we'll hear a lot about that next year. And that's why when we talk about things like AI, you know, which gets so much attention, or when we talk about all the investments to address climate and decarbonization, in many cases, both the AI spend will be targeted not just at productivity, but how to build deeper relationships and drive growth. The climate focus will not just be on being responsible, though that is job one for every company, but on building this into business strategies in ways that can create long-term growth, can drive value creation. I think those key macro trends that we talk about all the time will have a high underlying element of how do we use that to create stronger businesses and drive growth, not just around productivity or not just around, you know, other objectives.
Hey, Rich, we just got consumer confidence from the University of Michigan a little while ago, and it came in below expectations, which feeds into this whole conversation as well. And I'm curious how much constricting credit is something that you're hearing a lot about from your clients. I think that's something that's also, you know, when people are looking at mortgage rates also going higher, that's something that affects sentiment on the consumer side. All kinds of constricting credit, I would imagine, affects sentiment on the business side. What are you hearing?
Not so much yet, but I do think, you know, if I look at the press narrative for the last few weeks, I mean, in the spirit of I mean, with no disrespect to the press, which is always trying to figure out how to crystallize the story, there's a tendency to focus on where the downsides are. And having navigated a soft landing, I think far better than most of us would have expected a year ago, though we were probably on the more optimistic side ourselves. I think the narrative is shifted now to talk about what it means, the total cost of ownership, particularly if you don't have an existing mortgage, you need a new mortgage, or to buy a car when you need to take a loan out. And those costs are substantial. And we've seen the interest rates increases, and those are real issues. So I do think for people that play in the durables part of the landscape, and as consumers are longer and longer in their homes and might want to move, or longer and longer in their cars and might want to get a new car, I do think that if we can't start to moderate interest rates, not in the next cycle or two, the next Fed cycle or two, but over time, I do think that higher interest rate environment will have a negative impact. Of course it will, on some durables aspects. And I think Jay Powell just referred to that appropriately in his remarks.
Rich, great to speak with you immediately after those remarks from Fed Chair Jay Powell in Jackson Hole, Wyoming. Rich Lesser, Boston Consulting Group Global Chair. We appreciate the time this morning.
It was a pleasure. Thanks.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Are high rates going to be a headwind for growth stocks? They were earlier in the year. They seem to have been less so more recently.
In theory, yes. In theory, high rates should be a headwind for growth stocks and value stocks to some extent too. But that divergence can persist for some time. And so if investors would rather focus on the sizzle than the steak, so to speak, then they don't become a headwind until it's really problematic.
Back to the retail story. Nordstrom beat the street with earnings, but struck a cautious outlook for the months ahead, meaning a challenging time is far from over. Joining us now, we've got Yahoo Finance's Brooke DePalma with much more on them Johns JWN shares here today.
Yeah, good morning, JWN. Nordstrom, here we are. Nordstrom shares are down nearly 11% this morning after popping nearly 6% after they beat on both sales and earnings in their Q2 earnings report. But now investors really weighing on that cautious outlook that they prompted during the call, the uncertainty that lies ahead when it comes to theft, when it comes to a cautious consumer, and when it comes to the gradual rise of credit card delinquencies. CEO Eric Nordstrom weighing in deeper on theft, saying that they're at historical losses are historical highs. He also called it unacceptable and something that needs to be addressed. And he said that the company plans to invest in mitigating retail theft. He really said it comes down to local legislators, law enforcement, and teaming up with the retail industry at large to create solutions. Now, when it comes to that cautious consumer, the company did reiterate its 2023 outlook. It does expect retail sales and credit card revenue to drop between 4% and 6% compared to last year. But CFO Catherine Smith saying that consumers continue to be cautious and that it remains to be seen how changes in inflation and higher interest rates will affect discretionary consumer spending in the back half of the year, especially during one of the biggest time of the years for retail. Of course, that holiday season shopping right around the corner, and that rise in credit card delinquencies. Interesting there, especially Macy's investors spooked on Tuesday from that. Nordstrom, they saw credit card revenue up 10%, but the CFO, Catherine Smith, once again saying that they're seeing delinquencies rising gradually, and they are now above pre-pandemic levels, which could result in higher credit card losses in the second half of 2023 and into 2024. But she did reiterate, guys, that their credit customer is loyal. They said it also is a little higher quality credit customer. And so it'll be interesting to see how this all plays out. We know that consumers are really looking to value. And as Nordstrom looks to fix its inventory problem, it'll be interesting to see how it could play Nordstrom Rack in this value environment.
Right, and that was one of the bright spots that some analysts pointed to. Brooke, thanks so much. Appreciate it. Well, this morning, AstraZeneca announced it was filing suit against the U.S. for certain provisions on drug prices found in the Inflation Reduction Act. AstraZeneca joining the likes of Johnson & Johnson, Merck, and Bristol-Myers, as well as not-for-profit AARP, in the battle over drug pricing. Let's bring in Yahoo Finance's Anjali Kamlani to learn more about this story. Anj?
That's right, Julie. AstraZeneca now joins as the sixth pharmaceutical company to file a suit against the U.S. Health Department, Secretary Becerra, as well as CMS, alleging that parts of the Inflation Reduction Act are hampering innovation. We've heard this argument before from a number of other pharmaceutical companies. But in this suit, AstraZeneca pointed out a specific part of drug development, the Orphan Drug Act, dating back to the 1980s. And that, it says, has incentivized a lot of the rare disease drug innovation. And so the IRA, in effect, goes headlong against that incentive. And so it might disincentivize manufacturers. Now, it did also cite the Fifth Amendment, which is one of the three key amendments that other pharmaceuticals have cited. They've cited the First Amendment, saying that it is going against the freedom of speech. Fifth Amendment, that the government is allegedly seizing property in the form of these negotiations and negotiated prices. And the Eighth Amendment as well has been cited for excess fines for noncompliance of this program. So AstraZeneca put its hat in the ring with the Fifth Amendment, also saying that that is where it believes there has been an infringement and calling it unconstitutional as well. It is interesting to see this development. We do expect more companies to sign on and do expect more lawsuits as the administration looks to unveil that first list of 10 targeted medicines next week. So keep an eye out on that. We also saw a filing from AARP joining in on behalf of the U.S. government, That came last week, looking to side with the U.S. government against the suit brought on by the U.S. Chamber of Commerce, as well as a number of other chambers. They also said that they're going to be filing against Merck by September 18th, and against the suit brought on by industry lobbying firm Pharma on August 6th. So all told, certainly heating up to be an interesting time to look at this whole negotiation unfolding. Of course, the target for that is going to be 2026 when all this goes into play. So until then, a lot developing.
Yeah, indeed. Anjali, there's also news coming out about the weight loss drug Wegovy. What can you tell us about that?
That's right. Yet another study just came out to show that it does help reduce fatigue and shortness of breath and other symptoms of heart failure. That, in addition to a recent study showing 20% reduction of risk in heart attack, stroke, and death. And so this just adds on to the growing list of benefits that we're seeing for Novo Nordisk, the weight loss drug that could put pressure on insurance companies to then cover, now that it shows benefit beyond those weight loss benefits. So just another thing to keep an eye on, and just additional pressure for these insurers. And we do expect, of course, to see more studies on other benefits. These companies, including Eli Lilly for their Mounjaro, are, first of all, awaiting approval for weight loss, and also looking for other diseases and other benefits like sleep apnea and certain liver diseases. So interesting to see how this will all play out.
Yes, indeed it is. And thanks for keeping on top of all of the developments related to those new drugs. Appreciate it. Jennifer Schonberger spoke yesterday with Susan Collins, president of the Boston Federal Reserve, ahead of Jay Powell's speech today. Collins, not a voting member of the FOMC, but offered her outlook on the Fed's next steps amid uncertainty around future rate hikes. Here's some of that conversation.
Tell me, how are you viewing inflation now?
Well, I am seeing some promising signs that the work we've already done is starting to have the desired effects, and I think that there is more to do. And so I am looking holistically at the wide range of data, and I think at this phase it's really important for us to be patient and resolute.
Okay, so you say there's more work to do. How much more work is there to do?
Well, I think that it's going to take some time to really be sure that we are seeing the sustained realignment of demand and supply that is needed in order to bring inflation back on a path that will get back to 2% at a reasonable amount of time. So, you know, until we're actually at each decision point and we have all the data in hand that we're going to have, I don't think it's helpful to say a preset path. We may need additional increments, and we may be very near a place where we can hold for a substantial amount of time.
So we're going to get a couple more inflation reports between now and the September policy meeting. If we see those reports come in line with what we've seen for the past couple of inflation reports, a gradual cooling, if you will, how would you view that? Would you feel comfortable moving into an extended hold in September, or would you want to wait until November to get more information?
So again, I think it is not helpful for us to try to map out a preset path of where we're going. I think at this stage, even though I know that people would really welcome some very clear signal about exactly what we're going to do and when, but I think what's really important right now is that at each decision point, we look at the breadth of data holistically. Mm-hmm. It's a time when extracting the signal from the data is quite complicated, because some of the data are getting revised, because some of the data, the monthly data, are quite noisy. And so I do think it's extremely likely that we will need to hold for a substantial amount of time, but exactly where the peak is, mm-hmm. I would not signal right at this point. We may be near, but we may need to increase a little bit further.
Okay, you said it could be possible multiple increments, right? So I'm curious.
Well, I'm saying I think there are things on the table. Mm-hmm. So I have said that we may be near, we could even be at a place where we would hold, but certainly additional increments are possible, mm-hmm. and we need to look holistically. And be really patient right now and not try to get ahead of what the data will tell us as it unfolds.
I know you look at core inflation. You don't look at headline because food and energy prices
I look at all of it.
So volatile. Okay.
I look at all of it.
So then to your point, you know, gas prices, energy prices have really leapt over the past month. And I'm wondering whether there's concern about that creeping back into core and keeping that elevated if we were to see that continue. Many economists expect that to show up in the next inflation reports on the headline number, perhaps not in core. But how would you view that? How do you view that?
So that's part of the reason why I think being patient and looking at broader patterns, recognizing that the inflation numbers in particular, the numbers for food, for energy, have been quite volatile. They've been up, they've been down. Recently, we've seen some declines overall on goods price inflation, which has been helpful, but some of them could go back up, as you say. We've started to see some of the decline in rents come through in shelter inflation. I'm particularly focused on the non-shelter services, which is a place where I have not seen as much progress as I'd hope to see, which is part of that patience again.
Of course. I want to ask you about long-term Treasury yields. We have really seen those surge to near 15-year highs. How are you viewing them in the context of setting monetary policy? In some ways, is the bond market doing your work for you?
Well, you know, I think it all works together, and as part of looking at patterns and looking holistically, that absolutely fits in. So I think it's helpful that the higher, longer rates are consistent with an understanding that this is going to take some time. And so I see that as positive of the direction that we're moving in. And I also want to say, I've said for a long time that I'm realistic but optimistic that we can bring inflation back to 2% in a reasonable amount of time. There are reasons for that optimism, and there are also a number of different risks. And I think what we've seen is reasons to believe that that pathway has gotten wider.
You said, obviously, the Fed has said you're looking to raise rates to a certain level and then hold for some time. I know it's difficult to say based on the data how long that will be, but is this something that you're viewing towards holding through the middle of next year or more towards the end, fourth quarter of next year?
So, you know, the last SEP, the Summary of Economic Projections, that was a couple months ago, and we'll have another one in September. That had, by the end of 2024, some decline in rates. Exactly what the timing of that would be, I think, is part of my kind of holistic, patient outlook. Would be premature to give too concrete a signal, but I think it's going to take some time, and people should not be surprised about that.
So we're going to be at a 5 handle for some time.
We are going to be at a place where rates are restrictive, and again, trying to engineer that orderly slowdown of demand to rebalance demand and supply in our economy, which has been one of the things. And the data that we've seen on growth is closer to trend. We haven't really seen that slowdown yet, and that's one of the things that I'd be looking for, that orderly slowdown that's consistent with being a realistic optimist.
Okay, so to your point on the orderly slowdown, as you look to hold rates for some time at certain levels, as inflation gradually falls, how will you determine whether the policy rate has become overly restrictive and needs to be trimmed?
Yeah, so it's absolutely true that if you're holding rates at a certain nominal level and the inflation rates come down, that means your policy is getting more restrictive over time. And that is very important to recognize and would certainly factor into my thinking about the time at which we would start to bring rates down. So, I do think that is part of the broader kind of holistic mix.
I want to ask you about housing, because we're seeing mortgage rates now above 7%. We really haven't seen much of a reset in the housing market than perhaps people would have thought, given the 11 rate hikes that we've seen. But now that mortgage rates are at these levels, do you think we'll finally see a reset, or is inventory just too low and that puts too low and that puts a floor underneath the housing market?
Housing is really important. As I spend time visiting throughout the First District, which is New England, and housing is typically the first thing that I hear about. It is a real challenge for a variety of households, as you know, and also for employers in terms of being able to hire. So the housing challenges that we have seen arise from a variety of things and took time. It's going to take time for us to get to a place where there's more affordable housing, where housing prices are not as challenging for many. So you're right, for new housing, those sales are quite robust, which suggests that people are managing with the higher mortgage rates, and the inventory is extremely low, and that's true in rural areas as well as urban areas for a variety of reasons, some of which have to do with the pandemic and the low rates, which are locking many people in not to putting their homes on the market. So that's going to take a bit of time to unwind, and addressing the broader housing challenges is going to take many different groups across our economy, state and local governments, firms, private sector. It's going to take all of them working together, and it's going to take time to address.
And our thanks to our own Jennifer Schonberger for that interview. We've got much more markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What are investors too worried about?
In some respects, the economy. In other words, low-end wages are killing it. Consumers doing great, and they've been sitting there fretting over the economy and not worried about asset prices.
We heard from Fed Chair Jay Powell at Jackson Hole earlier this hour. He pointed out at the top, the message was the same, but a little bit longer here. In a fairly hawkish speech, Powell said that the Fed may need to raise interest rates further to ensure inflation is contained. One of their particular kind of call-outs from this speech, 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably towards our goal. He went on to end that particular part of the speech saying that 12-month inflation is still elevated and there is substantial further ground to cover to get back to price stability. Perhaps the markets might be latching on to that part of the speech.
Yeah, he seemed to leave the door open to a pause potentially, but yes, perhaps so. I'm glad I offered my disclaimer earlier that maybe markets would digest this a little bit more and not be so happy about it. If you take a look at the Wi-Fi Interactive, I've got to look at exactly what I'm talking about. And here's the Dow, and kind of going into the red here as we watch the continued reaction here. The S&P 500, we're seeing the same thing, and the NASDAQ the most here as we look at the reaction here. And this likely has to do with what's going on with rates as well, as we see rates start to move higher here in the wake of his commentary. So that's sort of the feed through from what we're seeing. And then as we look at what's moving within the stock market here, I know you like to look at the sectors.
Yeah.
So looking at the sectors here, Communication services down the most today, a sector that has become sort of interest rate sensitive sometimes, not all the time, but sometimes.
Contextually, for today's session, it's important to note all of these sectors were higher. 11 out of 11 S&P 500 sectors were higher to start off the day here, led by consumer discretionary. And now you're seeing a mixed equation here with many of those lagging. And of course, the declines, as you mentioned, led by communication services at this point. Technology, also one of the more interest rate or policy sensitive sectors in the market. You're seeing that down by about 0.5% right now.
Yeah, and the NASDAQ 100 is definitely seeing more deep red. Meta down 3.4%. It's in that communication services sector. Nvidia down more than 3%, pulling back after the big, the climb that it's seen this year, especially in earnings. Alphabet, aka Google, is down 1.7% as well. So we're definitely seeing a more mixed picture than we were earlier as we get this digestion. One other important thing to note here, and this is something that we talked about at the top of the show as well. It is August 25th.
Yeah.
A lot of people aren't around right now on trading desks. So because of the lower volume, you tend to see sort of a little more volatility, a little more swings in the market. So that's just something to keep in the back of your mind as you look at the reaction today and what we've been seeing.
Yeah, absolutely. You mentioned Nvidia. Nvidia, of course, had a lot of focus over the course of this week, and no doubt why, because of the AI push that we've seen in equity markets recently, but also because Nvidia was the company that really spurred a lot of that. Semiconductors also came up in Fed Chair Jerome Powell's speech as well, in the context of because the shortage of semiconductors, vehicle supply actually fell because of that. And so now you've got a different look across that industry and a lot of investment taking place.
Yes, we've got more Jackson Hole coverage coming up in the next hour, including the conversation with Philly Fed President Harker. Rochelle Akufo has got you for the next hour of trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. We just heard from Fed Chair Powell, where he struck a somewhat hawkish tone on the current state of inflation. We'll discuss coming up this hour. And we'll head back on the ground to Jackson Hole for an interview with Philadelphia Fed President Patrick Harker. You won't want to miss that. Plus, are you buying now and paying later? Well, Affirm certainly hopes so. The company's CFO will join us to discuss the company's latest results as they face a more discerning consumer. But first, let's check in on how markets are doing after we heard from Fed Chair Jay Powell. At first, a relatively muted reaction, but as we can see some of that selling action picking up, the Dow now off more than 50 points at the moment. The S&P 500 also losing some ground there, down about 0.4%. The tech-heavy Nasdaq down about 0.6% or 80 points, as we certainly heard from Fed Chair Powell that they intend to proceed carefully whether to tighten further or hold policy, but didn't hear the word cut. With that in mind, let's also check in on the Treasury market to see how that was impacted. We did see started to climb significantly after we heard from Fed Chair Powell. We see that the 5-year up more than 1.6% there, the 10-year also up about 1% there, and the 30-year as well up about 0.4%. Well, as we heard there from Federal Reserve Chair Jerome Powell this morning, his speech striking a somewhat hawkish tone, saying the FOMC is willing to tighten further if needed. Yahoo Finance's Jennifer Schonberger was on the ground at Jackson Hole, and she's here with the latest details. Hey, Jennifer.
Thanks, Rochelle. That's right. Fed Chair Jay Powell giving a major policy speech this morning right here in Jackson Hole, leaving the door wide open for the potential for more rate hikes, saying the Fed is prepared to do more rate hikes if needed. He referenced his speech from last year right off the top, saying that while his speech this year was longer in duration, his message remains the same, which is to bring the inflation back down to the central bank's 2% target. Now, even if the Fed decides not to hike rates again, Powell said that, quote, the central bank intends to hold policy at a restrictive level until we are confident that inflation is moving sustainably back down toward our objective. Powell also showing a strong commitment to the Fed's 2% target, saying that our inflation target is and will remain 2%, a nod to those calling for a higher inflation target. For more on this, I want to bring in Jim Bullard, former president of the St. Louis Federal Reserve and now dean of the Mitchell Daniels School of Business at Purdue University. Jim, welcome and congratulations on the new role.
Well, thanks very much. It's great to be here.
It's great to have you. Before we get into your new role, I want to get your reaction to Fed Chair Powell's speech.
Yeah, I thought it was moderately hawkish. He cited things that he said in the past, but in particular, I think that GDP growth is not really slowing down. It was above trend in the first half of 2023, and now it looks like the third quarter will also be very strong. Labor market remains very strong. Unemployment still 3.5%. So he mentioned these things in the speech and said that the committee may have to go higher on the policy rate. I think this is just reflecting the reality of the data that's coming in. They're really not seeing the below trend growth that you would need, nor the weakening of the labor market that they had expected.
You were long one of the most hawkish members of the FOMC, and you sat on the committee in June when we saw that you guys had penciled in 2 more rate hikes for the remainder of this year. Having listened to Powell's speech this morning, do you think there is more than 1 rate hike on the table for the remainder of this year after the speech?
Well, of course, the chair is very careful in assessing the situation, as is the committee, and they'll be data dependent. But right now, it looks like the data is not cooperating the way they would have thought. Unemployment is still 3.5%. And this faster growth now, a reacceleration in the economy, that sounds like a higher rate path than what you would have otherwise thought. Inflation has come down, but as the chair said in the speech, it's really the headline inflation number that's come down. The core numbers have come down a little bit, but not that much yet. And so you'd have to see sustained disinflation there in order to keep the committee at bay here, I think.
To your point, even though we saw some cooling in the past couple inflation reports, the data on core inflation is still quite high. Do you think that the Fed could pull the trigger to raise rates at the September policy meeting?
I think they've got optionality for that. They could do that if so desired. They've got some more data coming in before then. Another way to do it would be to wait for a meeting. Maybe they would play it that way. I do think, the committee's in much better shape than they were last year at this time or 18 months ago. So they made a lot of moves last year when I was on the committee, 75 basis point moves at 4 consecutive meetings. So that went a long way toward helping. But how to fine tune this and how to adjust this in the second half of 2023 is going to be a good question. But they'll stay data dependent, and they'll take a look at what's happening. But I think if you get this reacceleration, that's a serious matter, and the committee will have to address that.
So it sounds like they could wait till November to collect more data. Is that what you're thinking?
But I mean, where is this reacceleration going? I mean, you've got GDP now from the Atlanta Fed. You're 2 months into this quarter, and they're, it's very close to 6% annual growth rate. I mean, it's ridiculously high. Maybe it's quirky, but what if that drove unemployment down to tick down further? And what if the inflation number stalls a little bit? In those kinds of scenarios, I think you might get some movement by the committee, but they'll be data dependent. They'll wait and see how the data come in.
I want to ask you, Jim, about Treasury yields, because we have seen long-term Treasury yields surge to their highest levels since pre-financial crisis. How do you think the Fed is looking at these in the context of setting rates? Is the bond market doing some of the work for the Fed, or is it just cooperating now? Your thoughts on that?
It is cooperating a little bit. The bond market sometimes is at odds with the Fed, but sometimes cooperating. I would say, though, that the biggest thing about understanding these yields is that the Silicon Valley Bank situation in March caused a dramatic easing of financial conditions. And then a lot of people bought into the narrative that that was going to be the trigger that would cause recession for the U.S. economy. That hasn't really panned out. And I think what's happening is that that's now the market has to retrace. And so the lower bond yields that were in place in the second quarter are being replaced by higher yields in the third quarter here. And that makes total sense because the SVB situation did not turn into a catalyst for recession.
Yeah, so let's talk about, the terminal rate is one thing, right? But holding rates at extended levels for a period of time is another thing. Do you think that the market is underestimating just how long the Fed could hold rates at heightened levels and see a 5 handle really on the Fed funds rate?
I think they might be. I think, the chair didn't say anything about cutting rates today. And as far as I know, in public comments, I haven't heard anything like that except outside the Fed. So the people inside the Fed are definitely thinking that they want to see the core inflation come down more dramatically before they decide to make a change in policy. And if anything, the risks are piling up to the upside of the policy rate, that there might be further increases ahead if we get this reacceleration of the economy in the second half of 2023.
Jim, why do you think the economy has remained so resilient in the face of 11 rate hikes? Is it that the lags are longer this cycle around, or just frankly, the Fed has more work to do?
I think part of the rate hike cycle has been to just get off the very low near zero rates that were associated with the pandemic. So part of the rate hikes were just to get back to some sort of neutral or normal level of the policy rate. Then the committee had to go above that level and up to the 5 handle on the policy rate. So not all of it has been tightening policy. Some of it was just getting back to normal. So that's one thing I think to understand. The other thing is that the U.S. economy is pretty resilient. You have this residual fiscal policy hangover from the pandemic. Those savings are being spent down now by the household sector, but still consumption is pretty robust. And it's exactly what you would think. If the labor market is pretty robust, then usually consumption follows right behind that, and you get a pretty strong economy. Consumption is a big chunk of the GDP. So it does make sense to some degree that you'd be able to raise the policy rate dramatically without going into recession.
Jim, you were in your first week of classes as Dean of Purdue's Business School. A major change for you, having served in the Federal Reserve System for so many years. How does it feel? What do you hope to accomplish?
The Daniels School of Business has a lot of momentum behind it, a lot of backing, a lot of passion. I think we'll be able to build on the success that's already here and create a distinctive business school proposition. Purdue is number 4 in the nation in engineering. We're closely associated with the engineering school. We'll do more to integrate that together and create an even better brand. Our graduates do very well because they have a lot of technical background. And so we're expecting that to be the basis of our success going forward.
Now that you're an educator, I can call you Dean Bullard. What do we do about this $1 trillion plus student loan situation? You know, President Biden tried to cancel student debt. You saw the Supreme Court smack that down. He's tried to put forth another plan. But this is really a long-standing issue. How do we fix the system?
Well, one of the things that Mitch Daniels did here at Purdue when he was president was he froze tuition for over a decade. So Purdue has a much lower price point than the other major business schools. This means that our students don't have to take on a lot of debt, and they graduate with one of the lowest debt ratios of any business school in the country, or any university in the country. So we think we've got a good solution on that. I think for others that where they're racking up a lot of debt, they have to do that very carefully, and they have to have a plan to pay it back and a plan to get a job that will enable them to pay it back. So this has been a very difficult situation across the country, but we've got a good solution here at Purdue, we think.
Jim, thanks so much for your insight. I so appreciate it. Look forward to hopefully talking to you again soon.
Thanks so much for having me.
That's Jim Bullard, former president of the St. Louis Federal Reserve, now dean of Purdue's Business School. We'll be right back. You're watching Yahoo Finance Live.
Was Nvidia the spark that growth stocks needed to reignite?
We'll know that for sure over the coming weeks, but it certainly doesn't hurt. I mean, Nvidia has been the catalyst pretty much for most of this year in terms of sparking. You know, ChatGPT sparked the AI fever, but Nvidia really became the way to play it, and so it does seem to sort of give an all clear or safe to get back in the water, despite all the headwinds that might be hitting growth stocks. But it is a bit of it's an outlier. It's too tough to extrapolate.
Fed officials, policymakers, and academics are all gathering here in Jackson Hole for the Kansas City Federal Reserve's annual Economic Symposium. Joining me now is Jared Bernstein, chair of President Biden's National Economic Council of Advisors. Chair Bernstein, thank you so much for joining me.
It's a pleasure to be with you.
So the economy has been so much more resilient than many had expected in light of the Federal Reserve's most aggressive rate hiking campaign since the 1980s. How much of this resiliency do you think can be attributed to the president's big legislative wins on the Inflation Reduction Act and CHIPS Act? And furthermore, when you look out to 2024, given that a chunk of this has yet to hit the economy, can we expect a more robust 2024?
Well, Jennifer, I like the fact that you chose this word resiliency because it's something that President Biden and the team have long thought about. I think if you didn't come out of the pandemic-induced recession without recognizing the need for more resilient supply chains, then you weren't paying attention. So yes, the answer to your question is that legislation that this president has gotten over the goal line, you mentioned CHIPS and the IRA, are certainly in the mix. But those are longer-term programs that pay out over many years. I would have added the American Rescue Plan because, of course, that was the first big legislative achievement that President Biden achieved. And in that case, those deep investments helped companies and families get to the other side of the crisis. Checks in pockets, shots in arms, vaccination rates went way up, and that helped set up this very strong labor market recovery that we continue to enjoy today.
Well, the economy is very resilient. Inflation, while it's come down, is still too high. It's the number one concern for Americans now as it pertains to the economy. In fact, I just spoke with Boston Fed President Susan Collins. She thinks there may be more rate hikes in store to bring inflation down. What is the president, the administration prepared to do to try to bring inflation back down this fall? Any new actions in the quiver?
I think the key action from our side is continue doing some of the things that helped get inflation down from over 9% back in last June to 3.2% last seen. We have to build on the progress we've made thus far. Now, we talked about implementation of the Inflation Reduction Act. There are some very direct ways in which that helps to reduce price pressures going forward, particularly in the area of healthcare, but also clean energy production and the kinds of products that people will buy, whether it's an electric vehicle, a heat pump, something for your house, solar panels. And then, of course, on the healthcare side, the IRA saves 15 million families $800 a year on their coverage. Insulin prices down to $35 a month for people who need that. That's a big savings for them. And as the IRA continues to unfold, there are more healthcare savings in there from finally breaking Big Pharma's hold on Medicare's ability to bargain for lower prescription drug costs.
So I want to ask you about China. China's exports fell in July. At the same time, in the U.S. here, you're trying to lure manufacturing back to the U.S. We're seeing a lot of reshoring, and companies are trying to diversify their supply chains away from China, given the experience during the pandemic. Now, you've also put forth recently a long-awaited executive order, essentially limiting U.S. investment into China on semiconductors and AI. My question is this the beginning of, in some ways, a decoupling process from China's economy and a reordering of capital flows?
No, I see those as really quite different areas of policy and much more de-risking versus decoupling. So you mentioned particularly highly sensitive types of AI that can be militarized and weaponized. Quantum computing also should be on that list, and of course, highly advanced semiconductors. All of those are part of the executive order, and that's de-risking. That's not decoupling. Those are relatively small parts of trade flows, but they are highly sensitive technologies when it comes to our security. When it comes to broad trade flows, I mean, one of the things you can just point and click to the national accounts, at least through 2022. I think there's some cyclical movements there, particularly in China in more recent weeks and months. But you see robust trade flows, and that's important to us. We want to continue to see that. It's part of the effort to ease price pressures. But there is a real difference between de-risking, which is really a matter of national security, and decoupling, which is something that would really push back on trade flows that we value.
What's next for China when it comes to this administration?
Well, we're going to continue to work in all the areas of geopolitical and security sensitivity. I mean, I don't think anyone would be surprised to hear that people in very different departments than mine, so I'm not going to go into what they do, are watching very closely issues around weaponizing technology, for example. And that's why that executive order that you just mentioned is so important. This is, by the way, this is investment flowing from our country to China. And the areas, once again, quantum computing, AI, highly advanced chips, those are part of that executive order for security reasons.
Childcare is facing an existential crisis. In fact, we're up against what people are calling a childcare cliff on October 1st, with many of the subsidies and incentives that the president put forth during the pandemic set to expire. My question is, why hasn't the White House included a request for this in the supplemental? And do you worry that given where women are as far as the labor participation force at record levels, this could hurt them? And are you willing to reconsider a supplemental request?
Well, so first of all, CEA has written in particular about the importance of child care initiatives from that very perspective. And we've shown pretty clear evidence that helping to support child care, and this is something President Biden talks about a lot, no one should have to choose between getting their kids safe and affordable care or going to work. And typically we're talking about women in that case. And we know that countries that invest more in this have higher female labor force participation rates. So this remains a value. It's in our budget. We mention it in the supplemental. We talk about its importance, and we're really pushing Congress to really make the investments that are in our budget. Now, the ARP child care support was very, very important. There are a couple of 100,000 child care providers across this country who are still providing child care thanks to the help they got through the ARP. And by the way, it did permanently increase parts of child care spending, which took it from, I think, about $2.9 billion to $3.6 billion, so about $700 million. That's a permanent increase. So there are child care dollars flowing, but you are right. We need to do more. I don't think the supplemental is necessarily the path there. I think we need to implement legislative solutions, and there's no reason why Congress shouldn't support this.
All right. Well, Jared Bernstein, thank you so much for your insight. I so appreciate it.
Our thanks to Jennifer Schonberger for that conversation there from Jackson Hole. Well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Fed Chair Powell giving his big speech this morning here in Jackson Hole, but I've got so much more coming up. I'll be sitting down with Patrick Harker, president of the Philadelphia Federal Reserve. Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger here on the sidelines of the Kansas City Federal Reserve's annual economic symposium, joined by Philadelphia Fed President Patrick Harker. President Harker, thank you so much for joining me.
Thanks for having me.
So a couple weeks ago, you were of the mindset that the Fed may be near the point it could hold rates at current levels. Is that still your thinking here?
At this point, yes, although the data will dictate in the next few weeks what we do in September, and I have to be open to that. But I want to recognize that, first, people often think that we have different ends in means when it comes to the FOMC. We don't. We all want to get to the same place, 2% inflation. It's just a question of how to get there. For me, putting pressure on the economy, which we've done, I think we're in a restrictive stance, and keeping that pressure on is, from a risk balance perspective, to me, the right thing to do. Now, others may disagree with that, but I think at this point, just let things work through the economy. And I'm hearing this from a lot of my contacts. What I heard time after time, I was out in my district a lot this summer, and they all said, look, you've done a lot very quickly. Let us absorb that. Let us figure out, as bankers, what that means with respect to our loans and whether we're going to issue more or not. Companies, whether they're going to make the investment or not, et cetera. So I think we need to give it a little bit of time, but recognize that not raising rates right now still means we are in a restrictive stance. We're still putting pressure on the economy.
We're going to get a couple more inflation reports between now and your September policy meeting. We'll also get another jobs report. If the data continue to show a cooling trend in line with what we've seen on the past couple of reports, would you be in favor of moving into an extended hold at the September meeting?
Yeah, possibly. Yeah, I think at this point, that's where I am. If things change with those reports, if we're not seeing the kind of cooling, or if we see reacceleration, which I really don't see right now, then I may change my mind. But right now, I'd like to hold and see how things turn out.
And how long do you see holding rates at these extended levels, right? Because the market thinks that you guys are going to start cutting in the middle of next year. Yeah. Is this more of a longer term phenomenon towards Q4?
Yeah, so we clearly are going to hold through the end of the year, right? Next year, we need to let the data dictate that, right? We need to see what's going to happen.
How are you viewing the bond market now? Because Treasury yields have surged to their highest levels since pre-financial crisis. I'm curious how you factor that into setting interest rates. In some ways, is the bond market doing your work for you?
Yeah, so obviously the long end of the curve, there are a lot of factors, not just monetary policy that affect that. There are global factors that affect the long end of the curve. We just affect the short end of the curve. But yeah, it's doing some of the work for us for sure.
And given that we're seeing nominal yields bump up above 4.25 this morning, real yields bumping up to around 2%. If we were to see real yields get above 2%, is that going to be problematic for the Fed? What are you targeting as far as the real funds rate?
Yeah, we don't really target the real funds rate, right? We target inflation, unemployment. And so that's not one of the things, at least I target, and I don't think we collectively target. Again, if those rates were to increase, they will have clearly an effect on the economy, and that effect could be good or bad, depending.
Once you get to the certain level where you're going to hold rates for an extended period, as inflation continues to fall, how will you determine whether the policy rate has become overly restrictive and needs to be trimmed?
Yeah, we need to see clear signs we're moving toward 2%. Now, our view is we're going to get under 4 this year, under 3 next year, and in 2025 we'll hit 2. It's going to take some time. And I think we just need to be ready for that. It's going to take some time. That said, what I am really listening to is not just the data, the inflation data we get, but the soft data. What I'm hearing from my contacts throughout my district, and what I'm hearing from them is things may be, and I emphasize may, softening more than the data show. In that case, we'd have to react accordingly. But really, we need to see that play through the inflation data before I would be willing to take us off the hold.
How much longer do you think this economic cycle of growth can play out? I mean, no one canceled the business cycle, right? But the economy has remained so resilient in the face of your 11 rate hikes. But as you said, some of your contacts may be seeing some softening than what the formal data are dictating.
Softening. That's the key. It's not what we're not hearing anywhere is that things are getting worse, much, much worse. They're softening. We've even seen in our recent manufacturing business outlook survey a little bit of an uptick after many negative months. So it looks like we might be, our forecast right now is that soft landing is most probable. Not it's guaranteed, right? Nothing's guaranteed. But, I think we can this is possible for the economy.
I want to ask you about the relationship between wages and inflation.
Sure.
Because wages have really remained robust, even as inflation, while still high, is coming down. How do you explain that relationship? Is it that productivity perhaps is stronger than the data put on? Is it that the relationship has changed, or merely just a lag?
Yeah, I don't think the relationship's changed. It could be lag, it could be productivity. Combination of those factors. Where it really affects the economy, in my view, is in services inflation, service X housing, right? That is where we're starting to see some signs that wages are starting to soften, which is a good thing, because that is the one area of inflation. We've seen good inflation go down. We're going to see shelter inflation come down just mechanically, right? We're seeing that happen. But the service inflation has been stubbornly high. As Chair Powell said in his speech today, it's basically gone sideways. Right. So we'd like to see that continue to come down. And I think we're going to start to see that. Part of it is there's more labor. You see this with the JOLTS data. The openings have been declining. And what we're hearing from all our contacts is it's much easier for them to hire people right now.
Okay. In terms of longer term growth, as you look out for the economy and the job market, really the dating culture has changed so that people are getting married later in life and as a result perhaps having fewer children, which raises the question of population replacement absent proper immigration. So I'm wondering, what does that mean for longer term economic growth and job shortages too? Yeah,
that's a good question. One of my old colleagues, a very prominent demographer when I was a faculty member, would constantly remind me, demography is history. Demography drives much of the economy. It's not monetary policy, although important. Ultimately, long term, it's the population. So that's an issue for us. And there's a trade-off, right? You either get more productivity per worker or you get more workers. They're really the only two things you can do to increase growth. And in that case, immigration policy is not our business at the Fed, right? But it's clear what I hear time after time, contact after contact, is almost a pleading that some sensible immigration policy is put in place for the country. And you see this in, for example, wafer fabs are being built right now, onshore in the United States, but we don't necessarily have the talent to put the labor in there for them. So we really need to think comprehensively about, not only immigration, but also how to bring people off the sideline. The Philly Fed, we've been really focused on this with what we call the opportunity occupations approach. And we're really looking at jobs that pay above median wages that don't require a 4-year college degree. We have a tool, which is a great tool, the Occupational Mobility Explorer, where people can go in and say, with a little bit of training, what kind of job could I get in my region and what kind of increase in salary? We need to bring more people off the sideline who are sitting off the sideline, get them productively into the economy. The economy needs them. And they need to do it for their families and their communities.
Absolutely. And so what do you think this is going to mean longer term for rates? Actually, two-part question. One, are we in an era now where we're going to be seeing higher interest rates given where the economy is, given the strength of the job market? I know you expect cooling. And then two, given what we just talked about, what does that mean for the longer term for rates?
No, I think the longer term, so go back to 2019, before the pandemic. It's hard to remember what life was like then, given everything we've been through. We had low unemployment, low inflation, and trend growth. I ask myself, and I don't know the exact answer to this, but I ask myself, what's fundamentally changed in the economy, other than the demographic trends we're talking about, that would change the opportunity to go back to that situation? I think it's possible. I'm not saying it's for sure we're going to do that, but it's possible we could get back to that scenario. We've been there before. So we have a proof right there, right, that we've done it. And so I think we could possibly do that again.
To your point, I mean, the overarching theme here this year is structural shifts in the global economy. This, of course, coming off of the pandemic. I know we're early innings in the conference here yet, but having talked with colleagues, what are the takeaways? What are you hearing? What are your thoughts? I mean, to your point, the economy has changed greatly. You think we can get back to pre-pandemic? What are you hearing?
So that, again, this is the debate, I think, at the conference, right?
Yeah.
What has really shifted fundamentally? I mean, lots of things. Geopolitically, things have shifted. I mean, the horrendous situation in Ukraine, the trade tensions we have around the world, and so forth. So those things have shifted. But net, and of course, the advent of AI and other technologies, but net, how big an impact will they have on the global economy and on the U.S. economy? That's still an open question, and that's what we're debating here.
All right. Well, Patrick Harker, thank you so much for your insight. I so appreciate it. Hope to talk with you again soon.
Thanks.
That's Patrick Harker, president of the Philadelphia Federal Reserve. Back to you.
Are high rates going to be a headwind for growth stocks? They were earlier in the year. They seem to have been less so more recently.
In theory, yes. In theory, high rates should be a headwind for growth stocks and value stocks to some extent too. But that divergence can persist for some time. And so if investors would rather focus on the sizzle than the steak, so to speak, then they don't become a headwind until it's really problematic.
Affirm shares climbing higher today after the buy now, pay later company saw revenue climb 22% year over year and transactions per active customer jumped 32%. Affirm CFO Michael Linford joins me now for more on those results. I mean, we're continuing to see the stock just skyrocket today. A lot of focus on that full year 24 guidance, as well as what we've seen with really what's been the difference maker in this tough macroeconomic environment. What do you attribute this to?
Look, I think the Affirm business is really on fire right now. We have really dialed in our credit performance and controlled the outcomes that we need to control to perform well. We were able to drive real growth and show operating leverage at the same time. And I think that's really what investors are looking for us to do right now. And I take a step back. The way consumers are paying for things is fundamentally changing. And Affirm is best positioned to capture and harness that change. We have a market-leading business, and we're able to take share even with that leadership position.
Because, I mean, even as we look at the gross merchandise volume or GMV of $5.5 billion, that's up 25% year over year. And I know we always talk about sort of the resilience of the consumer, but then we have started seeing some cracks in that. So how are you managing, when you look at your consumer makeup, how are you managing the consumer and assessing them?
Yeah, I think one of the benefits that we have is a really broad set of categories. So in our fiscal fourth quarter, we saw really strong growth in travel and ticketing as consumers did spend more money on things that were experiential and moving away from categories that they spent a lot of money on during the COVID periods, for example, furniture. And because we're so well situated in a broad set of categories, we're able to meet the customer where they are in any part of the cycle. And right now we're experiencing that growth in those segments. And I think from a credit standpoint, our ability to control those credit outcomes is on full display right now. And I think that allows us to be very thoughtful and careful, but nonetheless very growthful, even in this environment where, like you say, other people are starting to see some cracks.
Now, it's interesting because we are still seeing, though, analysts split on the stock at the moment. We saw some concern, some caution coming out of Wedbush. They have an underperform rating on Affirm, and they were focused on the significant level of stock-based compensation, as well as competition in the buy now, pay later space, especially as some of these point of sale, some of these companies are trying to do their own sort of point of sale initiatives as well. How do you combat that, or how do you manage some of those risks?
Yeah, on competition, it's a question that we've really had been answering since we went public 3 years ago. And we include a lot of disclosures around our ability to earn merchant fees. And it's pretty remarkable how consistent the merchant fees that we've been able to earn have been really through all of the focus on the category. We're partnered with some of the largest enterprises, and they pick partnering with Affirm because of our ability to work at enterprise scale. And it really is differentiated versus any other player. And so I think that we're extremely well positioned to meet those large enterprise partners where they need to be and to help serve their customers in the best way possible. I mean, what we do is really hard. And because it's hard, the best companies in the world partner with us to do it.
And as we look at some of those key companies that you're partnering with there, I mean, this is coming at a time when, there's a lot of pressure on the consumer. You have student loan repayments about to kick back in, consumers starting to, pinch some of their pennies there, even some of, the wealthier people trying to now, spend more money at Walmart. How do you really manage those headwinds, and how concerned are you about how you might see that play out?
Yeah, I think we've seen a very resilient consumer in large part due to the strong employment that we've seen in the economy. And, I've said it before, I'll say it again, that the American consumer is super strong, and we don't bet against them. We do try to meet them where they are. And so for us, having a broad set of categories being distributed on brands like Walmart is really important for us. And we don't really focus too much on where they're going to shop. We know that they will be. And so long as we're distributed correctly, we're going to meet them where they are.
And I do want to ask you about the Affirm card, because we are seeing this focus, especially the difference that you see between people paying for things online versus the sort of spending that they see in store. Talk about the release of that and how people should be viewing it, because some analysts are really viewing this as perhaps something as an alternative to credit cards, but that seems to be misunderstood. That's not really what this is.
Yeah, we're really excited about the card. It's obviously very early and we have a lot of work to do, but the traction that we have and the growth that we're seeing on the card right now just really energizes everybody here at Affirm. We're seeing strong product market fit early for a really new financial product. This product lets consumers get the surety of a debit transaction for most purchases while still being able to have the Affirm installment loan options for things that are bigger and need to be paid for over time. So it's not a credit card, but it's also not like any other card that most consumers have seen before, because we bring the power of credit to a physical card. And it's really bringing all of the great things that we do at Affirm to a physical format, which lets you use it in a lot more places, especially offline. And one of the things we're really excited about that is the frequency at which consumers are using the product is substantially higher, and the frequency at which they're using it offline is substantially higher, and that lets us address more transactions, which for us is so important. The path towards being the true network that we want to be has to involve a substantial increase in frequency, and we're driving that. We're driving that with repeat transactions. We're driving that with frequency, as you mentioned at the top, but we're driving it with new products as well.
And I want to ask you about the better than expected loan delinquencies that you saw, because one of the things, especially with the card, it does sort of force you to take a second, perhaps plan out your purchase a little bit better. When you look at that against the backdrop of what we're seeing with, credit card delinquencies, how do you see Affirm's role in this going forward? As when, consumers also need some protection in terms of how they're spending and, how it's affecting their consumer behavior.
When we started this company, we were focused on making sure that we were going to make an honest decision in extending credit. We have taken away any way for us to profit off of a consumer's misfortune or mistakes. We don't charge late fees. We don't have any gimmicks or tricks in our product. And because of that, we have to be really good at underwriting or else we're not going to win. And so it's been in our DNA from day one. And the way we do that is we improve every transaction. And because we're looking at every transaction, we're actually asking the question, can the consumer and will the consumer repay for this transaction? And that's so important to how we run our business. And what you've seen over the past 6 months is that transaction level approach to underwriting is really differentiated versus anybody who's issuing credit in the form of lines.
Well, certainly important discussion to have, and we appreciate you joining us, and congratulations on a fantastic quarter there. Affirm CFO Michael Linford, thank you so much.
Thank you.
Well, shifting gears to SpaceX, it's delayed today's launch for NASA's astronauts to the International Space Station. The trip is now planned for Saturday. A separate launch for 22 of the company's Starlink satellites is still scheduled to go ahead at 9:30 Eastern tonight. Meanwhile, the U.S. Justice Department is suing the company over its hiring practices. The department says SpaceX illegally discriminated against refugees and asylum seekers. Joining us now is Yahoo Finance's Alexis Keenan to give us those details. Hey, Alexis.
Hi, Rochelle. Yes, the Department of Justice is saying that SpaceX violated a U.S. law that's called the Immigration and Nationality Act. What it does is it prohibits hiring discrimination for people against people who are granted either refugee status or asylum status. And the DOJ says that SpaceX CEO Elon Musk, as well as others at the company, wrongly said and represented in statements, in job ad postings, and other places that the company could hire only U.S. citizens. And that, they said, is because they put it on this federal export law that's known as the International Traffic in Arms Regulation. But the DOJ, they say that those laws treat refugees and asylum grantees as U.S. citizens for the purpose of hiring and employment. One example that the DOJ gave was a tweet from Elon Musk in June of 2020, where he said U.S. law requires at least a green card to be hired at SpaceX, as rockets are advanced weapons of technology. The DOJ also alleging that the company's application database that receives its job applicants entries for employment, that it repeatedly rejected applicants who either chose refugee or asylum as their status to work in the country. Now, Musk has already shot back on X, on Twitter, if you want to call it, accusing the Biden administration of weaponizing the Justice Department for political motives. Here's what he wrote there. He said SpaceX was told repeatedly hiring anyone who was not a permanent resident of the U.S. would violate international arms trafficking law, that law we just talked about, which would be a criminal offense. Now, he doesn't say who exactly told the company that. This case, though, is before an administrative court, and so we'll have to see what the next chapter here brings. But for now, the Justice Department is saying that the company has broken between 2018 and 2020 these employment type laws.
So then, in terms of relief, what does the DOJ want from this suit?
Yeah, so they're asking for some really interesting remedies here. And look, other companies like Walmart, CarMax, Capital One, these companies have all been involved in this type of action from the DOJ and had to pay penalties and had to have other problems and remedied here, but it's asking to stop the practices. Okay, so that would be like an injunction. Also, the DOJ wants SpaceX to pay some civil penalties and also compensate improperly screened applicants as the Justice Department sees it. Also, though, wanting to hire applicants who were these alleged victims of the so-called offenses, and also to pay them some lost wages that they say happened to them because they were not hired by the company. So those last ones there seem like a little bit of a complicated stretch, but that's what the DOJ wants. And so we'll see if SpaceX gets to the negotiating table on this, or if the case is going to take the next step in court.
And as you mentioned, that'd be tough to calculate those last two aspects of it. Appreciate you getting us up to speed. Alexis Keenan there. Well, members of the United Auto Workers overwhelmingly voted to authorize possible strikes against the nation's three major auto manufacturers. That's General Motors, Ford, and Stellantis. Now, this vote does not guarantee a strike, but it permits union leadership to call for one if a deal isn't reached. But time is short. Contracts are set to expire before midnight on September 14th. Now, the UAW says they made major concessions to keep automakers afloat during negotiations back in 2007. Now they want those benefits back. Union demands include a pension plan, major pay increases, and protections against job losses and plant closings. Negotiations have been unsuccessful as of late, though, according to UAW President Shawn Fain. He spoke in support of a strike earlier this week, warning automakers the clock is ticking to reach a deal. GM, Ford, and Stellantis have all issued statements in support of reaching a deal without a strike. Right, well, before we go, let's get you a final check of the markets as we head into the noon hour. As we can see here, we were all negative across the board here shortly after we heard from Fed Chair Powell. But now, as markets are digesting some of that information, gone back to a mixed picture here. We're seeing the Dow now, some of that buying action starting to pick up, about 100 points. The S&P also in the green, just the tech-heavy NASDAQ down in the negative there by about 10%, 0.1%. All right, well, that does it for now. I'm Rochelle Akufo. I'll be back with you Monday, 11 a.m. Eastern. See you then.